Hey, thank you, sir. Yeah, yeah.
I don't think they want to. That doesn't look like it.
Okay. So I will just have to hit return every now and then, huh?
Yeah, it looks like it's started out.
That's okay. Yeah. Let's see what we got here. All right. So we got a pretty good sized class. This is about the, well, I guess we're ready to get started. So hello everybody. My name is Paul Dunham. That's me here at the bottom. I'm filling in for Dr. Larson tonight and next week. So if for some reason you don't like tonight, don't come next week. Okay. He is on, I think he's in Atlanta at a professional seminar. And next week he's obviously going to be back here in the class. This is, I'm thinking about the 4th, 5th, 6th time that I have come to the Advanced Corporate Tax and done this presentation. I've done it in the past for Dr. Houston. I've done it in the past for Dr. Larson. I think Dr. Houston has gone to another university. I forgot which one. And Arizona State. Okay, I was thinking Texas A&M.
No, that's where they came from.
I was going to say it, yeah.
Because in being Arizona State.
He's still doing tax, isn't he in audit or something?
So he's in Arizona State, came from Texas A&M, so he's heading back out west. But I've done this several times. I hope you have fun tonight, as much fun as you can have as in an advanced corporate tax class, if there is such a thing. If we listen to me speak all night, it's going to be a long night. So I promise not to call on anybody or embarrass anybody, but I do need your help. I do want interaction with you so that we can get through this course tonight and essentially have you teach this course to yourself is what's going to happen. I'm just going to be interchanging with you, dialoguing with you in anticipation of the course tonight. I don't look too much because you got some of the answers.
Oh, okay. Try not
All right. Yeah, well, sorry. All right. So please interrupt me at any time. Again, I want you to ask questions. I want us to be interactive. I think Dr. Larson told me this class goes to a little bit around 10 or so. I will shut it down probably right at 9. Honestly, I think he told me 9:15 is when the class goes to. It's past my bedtime. I want to get home probably as much as you do. So I will promise that 9 o'clock, done, gone, bye, all done. Okay? So that's my promise to you. What do we, I wish I made this have to do a little back and forth, but I'm going to hide behind the screen here. Disclaimers, don't worry about the disclaimers. Question, a general question for the group. Anybody actually out there practicing, working in public accounting, doing tax returns? Anybody with the IRS? I always like to ask that first.
I work on the audit side today.
You work on the audit side, okay? So that's the other side that doesn't have personality. The tax folks are the ones that have personality. They tease me in my office. They say the tax department, all we do is check boxes, okay? But I tell them, you know, at least the box that we check has significant tax ramifications. We might save a client millions of dollars, or we may cost them millions of dollars. So I do love the audit, brethren. Now, do you, is that going to be your career path, or you're still not sure?
Yeah, I think for now.
I'll pray for you. And then over here, there's somebody else. Yes, ma'am.
What do I do?
Yes.
I'm at a mid-sized firm in South Tampa, doing the tax returns.
Okay, so you're in the tax department, mid-sized firm. Good, good. Second year? Still on the doing some 1040s, some small
Actually,
business
a little of
returns?
everything, because of the size we are, I used to do everything from foundation, corporation.
Okay, so all tax, not audited.
About a mass tax.
There you go. All in full disclosure, for myself, my background, I went to school here. It was several years ago. But I am a graduate here, from here. I have a master's in tax from USF. When I was going to school here, I was working part-time at a local firm. doing a little bit of auditing and tax. And then because of that experience and the training that I got here and the education I got here, I ultimately realized that tax was what I wanted to do full-time, full speed ahead. Graduated from here, went to work for, at that time, I'm aging myself, one of the big 8 firms, okay, which is now the Final Four, as we affectionately refer to it. So I went to work for one of the big 8, which is now 4 firms. I was there for about 6-7 years, and then ultimately came to the firm that I'm with now, CBiz MHM, which used to be called the Kirkland Russ firm. I guarantee if any of you know them, or are currently interviewing with MHM LLC. I understand we were just out here on campus last week, I think. Yep. So some of you all may have had a chance to interview with us or talk with us, and I know we're in the process. I don't have anything to do with that. So no money under the table or anything. It's not going on. Okay. But so what are we going to talk about tonight? Tonight's agenda, I believe it's on behind me. Yes. The agenda, the 2, 3, 4, 5 main things that we're going to talk about tonight are we're going to compare and contrast corporate acquisitions, taxable acquisitions versus tax-free acquisitions. And then in particular, when we talk about the taxable acquisitions, we're going to be contrasting stock acquisition versus asset acquisitions, because those are 2 very different results. We're going to talk about, which I think is very important, because as I go further in my career, and I learned relatively quickly and was taught here when I was sitting in your seat, that oftentimes non-tax reasons, non-tax factors will ultimately drive the structure of the transaction. You know, forget the tax part. I mean, you spent 4 or 5 years here in college learning the tax part, but oftentimes there are non-tax reasons that ultimately are going to drive the tax structure of the transaction. So we're going to talk about that. We're also going to talk about the importance of the acquisition type. You're going to find out that you don't already know, maybe in your studies that you've already done, there's some significant differences between a stock deal versus an asset deal. We're also going to talk about, in particular, some asset acquisitions. The purchase price allocation in an asset acquisition can have a significant difference in results. And lastly, we're going to play a little pretend, or what I call make-believe. There's actually some sorts of transactions that are stock acquisitions legally, but for tax purposes, we treat them as asset acquisitions. So we're going to cover that just about when you're ready to sleep or throw me out the door, which is one of the last things that we cover. A little bit technical, a little bit hard to grasp, so we save that to last just at the end. So, in its simplest form, I want to just briefly talk about taxable. What does a taxable transaction look like? And the next thing that I don't have is probably magic markers, for lack of a better term. There's this big black box down here, but there's nothing in here. So that's not going to work well. So I got to think about that temporarily. As Sergeant Gunny Highway. Any Sergeant Gunny Highway fans in here? Heartbreak Ridge, ever seen that movie? We're going to improvise, adapt, and overcome. So I'm going to try to figure out how I'm going to do that, since I have nothing to write on. Hold that thought. I'll figure it out. So a taxable corporate acquisition occurs when P, this purchaser here, buys T, the target. And I'm going to use those terms interchangeably. Purchaser, target, buyer, seller, you know, those terms are interchangeable. When P acquires the assets or stock of the target, or cash, notes, and or other property, and the acquisition doesn't qualify as a tax-free reorganization. Next week when I come out, if any of y'all are still left, is when we're going to cover the tax-free reorganizations in more detail. Tonight, we're just going to touch base and brush them a little bit because we're going to contrast them to a taxable transaction, and then we're going to dwell into the full taxable transactions. And next week is going to be the tax-free reorganizations. And I'm looking about, you all do have these slides. That's a technical term, you all, for those of you from the north. I was born in the north, but I've been here for a long time, so I have the you-alls and the whatevers, okay? Pull this out again to get returned. The premise, oh, I want to go back. Hold that one. It's counting job. I think I had about 22. 2, 4, 6, 8, 10, 11, 2, 4, 6, 8, 10, about. Ma'am, you can go either this side or this side. Where would you like? No, you sit right there. You sit right there. But you're going to be either with that team or you're going to be with that team. You're going to be with that team? Okay. So as we talk tonight, we'll do maybe not role playing, but we're going to talk about buyers and sellers. So if you're going to be with them, that's fine. I'm going to make, you guys want to be buyers or sellers? Buyers. Usually they pick sellers because they want money. So you guys are buying, you want to spend, you're investors, not you don't spend. So just remind me then, y'all are buyers, okay? Then this group over here is going to be sellers. And I'm going to ask questions and we're going to dialogue a little bit in that context. I have my buyers over here, I'll have my sellers over here, and you're going to join them. You might change your mind later. If they don't do what you want, then you come over here. But you're kind of like an in-between person here. But let's just play some pretend and get some dialogue going and get your thoughts thinking, if you will. I want to discuss 5 potential transactions. And I'd like you to tell me whether you think it's a taxable transaction, yes or no. And then yes and no's are always good, but you got to have the why to the yes or no. Anybody can say, oh yeah, it's taxable. Or anybody can say, oh no, it's not taxable. I've got an 8-year-old kid that could do that. And he's got something he told me the other day. I don't know if you've ever heard of this, but he told me, Dad, there are 3 types of people in the world. Did you know that? I said, no, I didn't know that. He said, yeah, those that are good with math and those that aren't. Now, honestly, I didn't get it for a while. It took me a while, but so he threw that one at me. But you have 5 different transactions here. I want you to be able to tell me the why. Let's assume that I have a technology company, okay, that is worth $10 million. And at least for this first scenario, you guys are all together, okay? You guys out there have a company that's worth $10 million, all right? Let's also say, for discussion purposes, that the basis in my company, my tax basis in my company is $1 million, okay? And for whatever reason, and I think in my example, you guys have developed some smartphone apps, and I have a technology company, and we've decided that it would be good to put our 2 companies together, okay? So y'all's company is worth $10 million, my company is worth $10 million, and we're going to merge them together. We're going to combine them together, okay? So, question, is that a taxable transaction or not? And if it is or not, why? Anybody? Yes, sir.
It's not taxable, and when you suggest for a merger, if it's mergers of companies, then
I want to suggest to you that you have the correct answer. And that is good. So you guys are already studying, or I've already covered that. We're going to cover it more next week. But let me, you're exactly right, first of all. So like, what's the thought process as to why that's the case? In other words, you did indeed hit, and we'll get this in the next week, the fact that that was to be exact, a 368 cap A, small a1 cap A, 368 A1A tax-free merger. Okay, you nailed it right on the head. But why do you think that's in the code? Step back and why do you think that's there that we could do that and merge those 2 companies? In my particular case, or in yours, I merged into you guys and I got y'all stock. Say, instead of my stock, and now my company's in your company, it was a 50-50 deal. Y'all's was worth 10 million, mine was worth 10 million. Why do you think in our tax code that exists? That the ability to do that? What's the thought process?
So you can have rearrange things without, a ton of consequences. You don't have to pay taxes just to restructure your business. There's a lot of it's kind of restructuring.
I like that response, and again, you are pretty much exactly right, but there's one thing that I'm looking for. Yes, sir.
I think it's just that it's the continuity of business. It's just continuing. You're just putting it all together, all the assets and everything.
And you also are exactly right, but I'm looking for something particular. I've never done that before, by the way. You sit up front. You sit up front. You could make some money here. Yes, ma'am.
It's kind of like the world called today, there was no cash in this transaction, so therefore there's nothing to be taxed on, no one's paying for it.
I can't buy anything for mama. Mama being my wife, of course. I can't buy anything for mama. And honestly, that's the truth. You hit the legal side. You hit the legal side as to why, this transaction would be permitted. I gotta get this back into before this. Why this transaction would be tax-free. And it's alluded to up here that the underlying basis for all the tax-free provisions is the fact that my old investment, I still essentially have my old investment with you guys unliquidated. I haven't gotten any cash. I haven't got any money that I can go buy that new car I want or buy a new ring for my wife or whatever. I don't have that cash. All I have is a piece of stock, basically. I had a piece of stock at the beginning of the day, and I had a piece of stock at the end of the day. So that is essentially why in our code we have those provisions. So, second scenario. You guys have been approached by Apple, and they are going to issue $10 million worth of their stock to you in exchange for your stock, so that you all are going to own. Don't hold me to this; just hold me to the concept. 0.00000000000000001% of Apple. Okay? So, does that change your answer at all? Taxable or non-taxable from you all's viewpoint? You're going to get $10 million worth of Apple stock, and I think I counted about 21, 22 of you. Let's keep the math simple. Each one of you gets 5% of 10 million, whatever that is. 50 grand? 500 grand? 50 grand? I can't do the math. Anyway, y'all gonna get 50 grand worth of Apple. Okay? Taxable or not? Yes or no? I'll let him answer again, but I want somebody else, if somebody else wants to take a stab at it.
No.
I heard enough right here. Okay, yes.
It sounds like a reorg. That's not for
Well, you guys have been doing too much work already. So you're on the B reorg, so stock for stock. Yeah, that would be a B reorg, and that does qualify as a B reorg. See, we're already on next week. I want to talk about tonight, but that's good. That's good. So now I already know that you guys got a good foundation for next. Dr. Larson's teaching out already. He usually stays away from it. He's trying? Yeah, he's trying. Yeah, he usually stays away from it, so I'm glad he's trying to do it. That's usually why I called him. He said, Paul, you do these things. Why don't you come on in and teach it? I'm going to Atlanta. I said, fine, I'll come in. But I'm glad you guys have already touched it. So yes, the bottom line is, yeah, I try to jazz it up a little bit, and not so much my company and your company getting together. I tried to jazz it up. I got a large publicly held company, huge. I mean, I don't know what their market cap is, 100 billion, 200 billion. I have no clue on how big the market cap is. But in publicly traded, and they gave their stock for your stock. It's still the same issue. You still haven't cashed in, if you will. Okay, so that is why that is tax deferred, generally speaking, under the reorganization provision. So let's just twist it just a touch, and you can see where I'm going on this continuum. There's a line of continuum here, if you will. Third fact pattern. Apple would like to purchase your company, okay? But you all are like me. You'd like a little cash, get that new car or whatever, you know, I got needs, I got needs I gotta get taken care of, I need a little cash. So the deal's been restructured a little bit. And they're gonna give you $8 million of Apple stock and $2 million of cash. Taxable or not, and if taxable, why? If not taxable, why not? Generally speaking, we won't have to get into all the reorg provisions until next week, but just conceptually, what do you think? Yes, sir.
The cash would be taxable, and the stock would be taxable.
Actually, you're right. Generally speaking, it depends on how it's structured. We'll get into it next week. If it was structured as a B reorg, we've blown it, because we'll get into it next week. He's not allowed any cash. If it was structured as a merger with some cash, then what you said is exactly right. We would be taxed on the cash portion, but we'd be able to defer the gain on the receipt of the other stock. Now, in my example, let's say it was me instead of you or let's just say it was y'all, that your basis in that stock was $1 million that you exchanged. When you get $10 million of Apple stock, what is your realized gain? I'm sorry? $9 million. $10 million worth of Apple stock in cash versus my $1 million basis. That's a realized gain of $9 million. But how much is recognized? And we'll talk about it more next week. It's actually the lesser of the gain realized or boot received. In this particular case, the boot received was $2 million. And as the gentleman had mentioned, the $2 million would be taxable in that gain. So, how about the fourth type of scenario, where you guys sell your stock to some unrelated party, somebody, for cash and a note. And let's just say 80-20, $8 million cash, $2 million note. Taxable or not taxable? Why or why not? Right here, go ahead. Okay, how much and why?
You said like 80 was a cash.
Yes, ma'am. And $2 million was a note.
I think it's all.
So 10 million proceeds, if you will, $1 million basis, gain of 9 million, if you will.
Well, actually, you can do it on
That's what I was looking for. So we caught yourself.
or you have to installment, let's make it lunch.
That is exactly right. You are exactly right. So yes, so you hit the two key points that I was looking for there. Generally speaking, yes, I sold it for cash and a note. Generally speaking, that is a taxable transaction. $10 million of proceeds, $1 million of basis, $9 million gain. However, in this particular fact pattern, there's an installment note involved. And generally speaking, in the fact pattern that I gave you, you could or you would, if you wanted to, you would deploy the installment method, and you wouldn't pick up the gain on that $2 million note until you actually got cash. If for whatever reason you didn't want installment method and you just wanted to pick up gain all up front, probably not likely, but if you wanted to, then you would elect out of installment sale basis because the installment sale provisions are statutory. When I say statutory versus elective, what does that mean? A default kind of. We're going to talk a little bit about it more next week. Yes, sir.
Are you talking about making an election exceptions?
Yeah, like elections versus statutory provisions, or let me put it this way. this installment sale that I was just talking about. Or I tell you what, let's go back. This is, did y'all do section 351? Maybe it was one of the first things you did in this class, 351. Basically says no gain or loss shall be recognized to the extent that property was exchanged solely for stock, and immediately after the transfer, we were in control of the company, right? And I pretty much summarized it, but more or less, at this point, I'm not sure. My point there is that if you have a 351 transaction, can you elect out of a 351 transaction?
No.
It is what it is. In other words, it's statutory. If you meet these rules, if you've met what I just said, transfer of property, solely in exchange for stock, and after the exchange, in control 80%, if you've met that, it's non-taxable. It's a section 351 transaction. You can't say, I understand that I've met all that, but I don't feel like doing that. I want to pick up the income. It's not elective. That's a statutory provision, okay? But there's other statutes in our code that say if you elect, you may do this, A, B, or C, or whatever. So the point being is installment sales are basically what you're supposed to do. And if you don't want to do an installment sale, you elect out of it. So that's what I mean by statutory versus elected provisions. But, all right, so I think already, and I don't know if it's, I guess it's not because you guys are smarter or what, but I already feel that you're much further ahead than some of the other classes I've done in this presentation. But I appreciate and like the fact that I'm hearing a lot of good stuff. So it'll be interesting how the rest of the night goes. I'm just going to take a look at these. I believe I've covered these next few slides. So let me just look at them real quickly. The first bullet point is what we emphasize, that although there's realized gains or losses, none are recognized because our investment was just continuing. But for the second bullet point, pro tanto, means that to the extent you receive boot, you recognize boot to that point that you've received it, the lesser of gain realized or boot received. There's always somebody in there thinking, yeah, Imosabi, I said pro tanto. There's always one in the class, but I guess nobody got that one tonight.
I have a question.
Yes.
We've talked so much about the rules, but we haven't talked a lot about application, tax returns, and really presenting some of these elections. With the 351 transfer, is there a disclosure required aside from?
Short answer is yes.
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 What is the disclosure?
Yeah, in the regulations, if you look up 1.351 and change, they basically would say the date of the transfer, I don't know specifically, the date of the transfer, the fair market value of the stuff transferred, the tax basis of the stuff transferred, and how much stock you got after the transfer. Generally speaking, it may not be exactly, and then the recipient company would report the same information. So yes, you do report that and you show that, but here's the deal. That is a statutory provision. So even though you're supposed to attach a statement to the return saying I did a 351 transaction, if you don't put that statement in, oh well. It's still not a taxable transaction, okay? But you are supposed to put into it a statement that states those things. And next week when we talk about the tax-free reorganizations, they also have reporting requirements that you're supposed to report, including an attachment, the merger agreement, the basics of the transaction, what was transferred, when was it transferred, how much was it worth, what was the tax basis, any gain realized, any gain recognized, maybe attach that to the return. Now, if you don't attach it, to some degree, oh well, because it's a statutory provision, it's still not taxable, you just, didn't attach the information you return. Versus an election, usually with an election, that's being attached to the return, or a box is being checked on the return, that's a totally different animal. That election isn't attached to the return, or if the box isn't checked, then yeah, That's a problem. You didn't make the election.
So if you had a client that said, I don't want you to spend the time on reporting my 351 transfer, would you still sign the tax return?
I wouldn't lose sleep over it, but you put me in a spot.
Okay.
Yeah, I wouldn't lose sleep over it, but technically you should. So I'll tell you what you should do, don't do what I do. Okay? All right, so acquisitive, we talked about that. I use this term loosely here, corporate, it's kind of like a corporate like-kind exchange. We'll talk more about it next week. Clearly, corporations don't have like-kind exchanges. Stock is not a like-kind asset under section 1031. I was hoping y'all know that one. All right, 1031, like-kind exchange provisions. Got that. Got that. Reorganization. We're going to do more of this next week. I'm going to touch on it just ever so briefly here. What is a reorganization? It's a merger, consolidation, a recap, asset and stock exchanges, divisions where you take one company. HP is doing a split-off, or spin-off, not split-off, a spin-off as we speak. I don't remember what it was, but I think they're maybe doing their printers and some other stuff in one company and then doing their corporate services or whatever into another company, taking HP and spinning off into two different divisions. So that's a spin-off. We're going to talk about that next week a little bit. And 368A1, we'll talk more about that next week. I wanted you to just grasp this slide as to contrast a tax-free transaction to a taxable one. Generally speaking, in a tax-free transaction, no gain or loss. And so if there's no gain or loss, what would you suggest intuitively what the basis is of the assets going in? Carryover basis. What would you suggest, the basis maybe of stuff coming to you? Substituted basis. It's not a taxable transaction, so intuitively you would say, okay, this is, basis carryover, tacking for the holding period, etc. Contrast that to a taxable transaction. Generally speaking, what would you see? Gain or loss on the sale, new holding periods, a step up on the basis of the assets purchased or the stock purchased. So really the purpose of this page or this schedule is just to basically remind you, emphasize that with a tax-free transaction, again, generally speaking, nothing's happened at the beginning of the day, I own this and I exchange it with this, but they're still together. I still have the same thing that I had, it's just in a different form. Versus taking that and turning it into, that, okay? So that's really all I wanted to say there. Let's say item number 4 up there, survival of tax attributes, NOLs, counting methods, credits. If you take one company and you merge it into the other company, generally speaking, those attributes are just going to come into the new company under 381. Generally speaking, if you have an asset purchase from a target, generally speaking, that target's going to liquidate and go away, and that corporate history or whatever is going to go with it. So just a very global comment and a reminder of a contrasting between reorganization provisions and taxable transactions. Generally speaking, we've got 2 types of taxable transactions. One is an asset acquisition, and basically in an asset acquisition, you've got the target company here, and you got the purchasing company here. And I'm using companies, the purchaser could be individuals, could be partnerships, could be whatever, but I'm generally speaking using companies. So this company in an asset acquisition would purchase the assets of the target, and then generally speaking, the target would liquidate, okay? And generally speaking, the target is going to have a gain or loss on the sale of those assets. And then also the shareholders are going to have a gain or loss on the liquidation of the target. Okay? So therefore you have double tax, corporate level tax and then a shareholder level tax. We're going to go through some examples here in a bit to drive that point home. The acquirer bought those assets, so they're going to step up the assets to the purchase price of what they paid for depreciation, amortization types of purposes.
You said there was a report annual loss on the assets?
On the sale, like when this target, when they sell those assets to the buyer in an asset acquisition, there will be a gain or loss in a taxable transaction.
And then you said the shareholders, they recognize gain or losses?
Sure, what's going to happen is, and I'm using a C corporation as an example, you know, picture the fact that we just sold all of our assets for $10 million. Now I got $10 million sitting in that corporation. That corporation, you know, it's basically done and sold its business. It's going to take that $10 million and give it out to their shareholders, you know. And so that's that second tax. That's the classic double taxation of C corporations. Okay? And we've got an example to really drive that point home coming up. Stock acquisition, relatively straightforward. I've got the purchaser over here, I've got the target over here, and the purchaser buys the stock of Target directly from the owners, so that at the end of the day, you've got the buyer up here and a subsidiary, if you will, underneath it, right? And the previous owners of the target got cash, okay? So in a straight stock acquisition, you know, the purchaser buys the stock from these owners and then becomes a subsidiary under the parent. The second, the seller, generally speaking, will recognize capital gain on the sale of their stock. The purchaser, with regards to purchasing the stock of that target, and that target comes underneath there as a parent sub. This target, what happens to the inside of that target with regards to tax basis? We just paid $10 million for that stock. What's the tax basis of the assets within the company? Well, I got a 50-50 chance. I got stepped up and I got stays the same. So somebody start pulling it one way or the other.
You're only buying the stock, right?
Yes, sir. So you still like your answer or not?
Yeah.
Do you still like your answer or not?
Where is the basis of stock, the assets?
I'm talking about the assets within the target company.
Yeah, I think he's right too.
So you're going to switch and go with him? You sure? That's a right answer. So yes, it does not get stepped up. So you've got parent, sub, and the inside basis of those assets does not get stepped up. Okay? So I think it's usually at this point in time, if you're starting to get this, I don't know why I had a headache. I actually been teaching a lot this week. I've taught for our firm for 2 days, and I'm doing this tonight, so maybe that's what it is. But I enjoy doing it, but I'm not sure why I got a little bit of a headache. But, because y'all are doing great. My buyers over here. Generally speaking, are you going to want to do a stock purchase or an asset purchase? Hold that thought. You guys are sellers. All right, so you guys, generally speaking, don't want an answer. I'm going to come back to them in a second. Generally speaking, as sellers, you know, would you want stock sale or an asset sale? So I'm coming back to the buyer. Generally speaking, what do you want? You guys, yeah, okay, you're back on. Sorry. Peer pressure.
I know why it's there. It's just-
Peer pressure. So you guys are going to purchase assets. You would prefer to purchase. That's why.
Because of the liabilities.
Actually, hold that thought because we got some other reasons on that. The main one, step up in basic. That's what we're looking for. Hold that thought because that's going to be the right answer here in a second. Okay? Yeah, cost recovery for the step up in basis and amortizing depreciation. So on the purchaser side, and you're over there, right? You're here. So I want you to come into this group. So on the purchaser side, you're gonna wanna buy assets. Sellers, talk to me. You wanna sell assets or do you wanna sell stock? Just on what we've heard so far today and or what you've already learned from either corporate tax or your other classes. What do you guys wanna do? Sell stock. Pretty convincing, right? Okay, well, here's the problem. I just got done talking to these guys, and they tell me they're buying assets. Yeah. And I've just talked to you guys, and you guys told me you're selling stock. So how are we going to get a deal? How are we going to get a deal done? How are we going to get a deal done? Pardon me? How are we going to get a deal done? Possibly. Whoever said that, we're going to talk about that. Good, good. Well, you guys are sharp, man. I'm impressed. An intermediary?
Real sneaky rules that you can sometimes do. That's what
No, but intermediary is, it might be a decent term. I mean, you basically negotiate. You negotiate it. You have to understand how the game is played. You have to understand which side of the fence you're working on so that you know what the other side's going to want, and so therefore you negotiate accordingly. If I'm representing sellers, guess what I want to do? If I'm representing sellers, guess what I want to do? I mean, generally speaking, I'm going to want to sell stock because I want to help my clients tax efficiently dispose of the business. It's the most tax efficient way to do it. But then if I'm working for the buyer on another deal the next day, guess what? I'm over here. What am I pressing for on the buyer side? I'm pressing for an asset acquisition. So as you're out in practice, working with clients or businesses, if you're working in your tax departments or what have you have to understand how the game is played and then just include that in part of your negotiation. And I don't know if we have an exact example, but it might be something like this for the buyers. And I'm just pulling numbers out of the air. Don't hold me to the numbers, hold me to the concepts. So the buyers might say something like this: we want to buy your assets. I ain't selling you the assets, I'm selling you the stock. All right, well, here's the deal. I'll pay you $2 million for your assets. Or I'm only going to pay you $1 million if you insist that I buy the stock. Because you guys have to weigh what that depreciation or amortization benefit is to you. And if you're not going to get it, then you ain't going to pay for it. That English should be proper English in college. But if you're not going to get it, sellers, you got a choice to make. Okay? And you just got to run the math. You can either sell the assets for the $2 million, sounds like a better deal maybe, or maybe selling the stock for $1 million is still better than selling the assets for $2 million. Okay? So you just have to understand how the game is played, understand how the calculations are made, and then ultimately understand how to negotiate and ultimately get to where you want. And when we represent sellers, that's pretty much exactly, keep going over that. When we represent sellers, that's pretty much exactly what we do. We say, okay, here's the deal. If you sell stock for $5 million, this is what you're going to put in your pocket after tax. They're going to insist to purchase assets, and for $7 million or $8 million or $9 million, whatever the number is, you're going to ultimately end up at the same amount. So there's your equalization point, if you will. Go for it. Go negotiate it. Okay? But at least we can give them some parameters and a perspective that, for a stock price of this, you get this. And in order to get this in an asset sale, you need a price of that to get to the same spot, and then let them go. Then it's just a matter of, getting the deal done and negotiating. Yes, ma'am?
So if you were a seller, would you have to disclose if, like, let's say you qualified for like the qualified small business exemptions, would you have to disclose that up front? Because then the benefit you receive should offset, kind of like what you were saying earlier.
No,
Would you never disclose that? It would never, wouldn't matter, it would.
it's not, they're sellers, but yeah, as the buyer wouldn't care. Sellers don't care, but there's not.
Right, so even though it's some sort of taxable benefit,
To the seller.
it's great.
It has nothing to do with you, that's like their benefit. Okay? All right. Let me see where I'm at here. I've alluded to this a little bit already, but maybe just to make the point. You got to remember all perspectives of the transaction. You got to remember what the buyer's perspective is on an asset sale. You've got to remember what the seller's perspective is on an asset sale. You've got to remember what the buyer's perspective is on a stock sale. You've got to understand what the seller's perspective is of a stock sale. You have to understand the gain. You have to understand where the other side's coming from and what they're going to want. And then I want to take a minute here and talk about from an asset acquisition standpoint, what are some non-tax factors that may influence you to want to do an asset purchase instead of a stock purchase? Liability. So obviously, on an asset purchase, you get to pick and choose. You get to pick and choose what assets you're buying. You get to pick and choose what liability you're going to assume, if any. What about on a stock purchase? Do you get to do that? You get the stock of the company and all the good, bad, and dirty or whatever inside of it. So that is one specific non-tax factor. And, you guys as buyers, that just might not be a negotiating point for you, period. I'm not buying any stock, period. And it's not so much the fact that I don't get the tax write-up, it's just the fact that if I buy stock, I'm getting all your liabilities also. So if you said that to them, what could you guys say back? Well, what you can say back is, I hear you. I hear you that you don't want to buy my stock, that you want to buy assets, and you're not so concerned about writing them up, but you're not so concerned about not writing them up that you're concerned about liabilities, okay? And that's why you don't want to buy my stock. So what we would tell them is, all right, here's the deal. We're going to sell you the stock because you don't really care about writing it up, but you do care about liabilities. So what we're going to do is we're going to enter an agreement with you that says that we will cover the first $500,000 up to $2 million of undisclosed liabilities that occur within the next 5 years. Deal? Yeah, maybe not. But the point being is understanding how the game's played, understanding where the parties are coming from. Then either we might get them to go ahead and buy our stock anyway, or we just might be right back to square one, that was just what we call a red herring, that the real reason why they want to buy the assets is what we've already said. They want to step them up. But what other non-tax factors might be out there? Let's say that the sellers or the target has like 5 lines of businesses. That give you a hint? Don't want to buy all of them. There might be a couple of them that you like, and the other one you don't want, or what have you. So obviously, in a stock purchase, what do you get? You get everything in there. But an asset purchase, you get to pick and choose. So there might be a line here that you don't want, and You'll just buy everything but that line, okay? And lastly, it is a little bit more costly from a legal paperwork perspective to buy and sell assets than it is stock. Because in buying and selling assets, I don't know if y'all have the business law or how they still teach that anymore for a CPA exam or what have you. But with regards to tangible property, fixed assets, you got UCC filings, stuff like that. With real estate, you'll have mortgages. Maybe they got to be re-recorded because it's an asset purchase. If you really are just buying the stock of the target, the paperwork is relatively straightforward. Really not much additional paperwork or transaction costs associated with it. So that is another non-tax factor to the asset acquisition. What about stock acquisition non-tax factors? Anybody throw me out? You've already got two of them. I had four. Where it's simpler to execute, I just gave that to you. We've already talked about the liabilities, that if you purchase a stock, you have the whole thing. I had two others in mind. One of them was very important, one of them maybe not so much. What about, it's not uncommon to have non-transferable assets. And if you all as the sellers have non-transferable assets, how are we going to sell it to them? Well, we can't sell the asset to them. We've got to sell them stock, because we can sell the stock, we just can't sell the asset. So if the target has non-transferable assets, that may indeed be a non-tax factor that's going to drive the fact that you got to do a stock purchase. And I appreciate the 338 comment, because we're going to talk about that later. But you all as buyers, if you want their company, and they have their company is built up mainly in their goodwill and their value is mainly built up in a non-transferable asset, you're going to have a choice. You're going to have to buy the stock. That's not totally true, because we're going to come back to 338, okay, a little later. But generally speaking, you're not going to have a choice. You got to buy the stock. There's no way to transfer that non-transferable asset, but for buying the company, the whole company, buying stock. And lastly, if you guys are selling the assets of the company, I want to suggest that the board of directors can pretty much kind of do that, collectively decide to sell the assets of the company. But so you can pretty much get it done. But if we're selling stock, and for some reason those two back there, they got more needs than you all, and they don't think the price is good enough, they don't want to buy 80% of the business, and those two want some more money. So y'all are going to have to talk to them to accept the deal, or those two minority shareholders back there are going to kill the deal. Okay, so sometimes it is another non-tax factor or reason that they may not want to do a stock purchase, because we might have some minority shareholders that don't want to do the deal. Okay, so let me hit a couple of slides here. I believe we've covered them. There's the non-tax factors on asset acquisition. We've covered all those. Stock acquisition, non-tax factors, we have covered those also. So let's talk about the varying results and really drive into this whole concept of what's the big deal. It's a big deal because it's money and makes a big difference. So let's take a simple fact pattern that I have up here. A is the sole shareholder of Target. So that would be you guys, your A, if you will. You're a sole shareholder of Target, a C Corp, important factor. And you guys have $100,000 basis in T stock. And again, to make the example easy, T's only asset is a building, and it's worth 400 grand, and the basis is 0. P wants to buy that building for $400,000 of cash. For discussion purposes, assume the corporate ordinary rate is 35%, and you guys can probably tell when I did these slides, the capital gain rate I had at 15%, because that's what it was 2 years ago. It's now 20, but for this discussion purposes, capital gain rate 15%. So let's talk about the after-tax economic impact of an asset purchase or a stock purchase, or from the seller's viewpoint, an asset sale or a stock sale, using simple math, simple example. The seller's view. Okay, so you've sold the building, the corporation has sold the building for 400 grand. In my scenario, to make it simple, I said the basis was 0. So we had a $400,000 gain. I stated in the fact pattern that the corporate tax rate was 35%, and if I've done my math properly, 35% of 400 grand is $140,000. So $400,000 of cash went from them over here to this corporation. Then, out of that $400,000 cash that we got, we then cut a check to the IRS for $140,000. So, you all are USF students, and you all have impressed me already tonight. If 400 came in and 140 went out, how much is left? 260. So we got 260 left that you all distribute out to the shareholders. All right? I said in my fact pattern that you all had a basis of 100, was it?
Yeah.
Yes. Yes, you all had a $100,000 basis in your stock. So you just received $260,000 as a liquidating distribution, and you had a $100,000 basis. Some people might think I'm dancing, right? So you received 260 versus 100, okay? So you got a $160,000 capital gain that you individually as a shareholder are going to pay $24,000, 15% of the 160, $24,000 to the U.S. government. Forget states for a moment, to the U.S. government. A's after-tax cash flow, net, when it's all done, $236,000. So $236,000 is what you all have left. Buy cars, houses, jewelry, whatever you want to do. Save it, spend it, whatever. $236,000 at the end of the day. Okay? All right, now, let's do a stock sale. Same fact pattern, it's just a stock sale. And write that number down. Was it 236? How does the stock sale work? A little bit simpler. You guys are going to sell your stock for $400,000. Your basis in that stock was $100,000. 400,000 minus 100 gives you a capital gain of $300,000. I've stated that the capital gain rate was 15%. So 15% of the 300,000 is 45 grand. So the money available for Mama on the stock sale is 355. So it's 400 proceeds minus the 45 tax. You put $355,000 in your pocket. So being the top grade graduate students that you are, would you suggest that you'd rather have 236 after cash, or would you suggest that you'd want 355? I think we all would vote, obviously, probably for 355. Okay, and clearly that emphasizes the tax effects, we stated earlier, just in simplest numbers, the double tax effect of the C corporation, sale of the assets followed by liquidation of the company. And guys, and I tell my folks in the office all the time, and I tell students like you all, you can add as many zeros to the end of that as you want, it's still the same answer. You know, I mean, we're using somewhat simple numbers, 400 grand. I've done 400 million in sales, sale of company. I haven't done much more than 400 million, but, pick the number. It's the same thought process, same approach. You okay, or you have a question?
Yeah, I would just, because you said on the C corp, I was thinking about the dividend and the C deduction, but.
Yeah, that would only apply an affiliated group, parent sub, where you would have that exemption, if you will, 100% parent sub, but not in a corporation to its individual shareholders, if you will. Okay. So, did we emphasize the sellers, and we've just kind of calculated and proven your intuitiveness of, yes, I'm probably going to want a stock sale as opposed to an asset sale. And then over on the buyer side, it's relatively straightforward and easy to follow. It's one slide. From the buyer side, on the asset acquisition, you guys have a building now that you paid 400 grand for it, and you're going to be able to appreciate that building now, with $400,000 cost base. So you're relatively happy. You paid 400 for it, and you're going to be able to write off $400,000 over time. I would suggest that you might not be as happy. Yes, sir. Okay. I might suggest that on the stock acquisition, you're not as happy because you just paid $400,000 for that stock for the company. And what is still in the company? The building, right? With zero basis. So guess what? You just bought. You bought their problem. Okay? You just bought their problem. They just stitched it, if you will. Okay? They just sold you their problem. Now you might have been okay with it. Again, we're using simple facts here. This is just a building. But I mean, if it was an operating business and it brought accretion to your company and you're fine with it, then fine. As long as you know all the facts and what you're doing, it's perfectly fine. But they just sold you their problem. So now you've got a corporation with a inside basis of zero that's worth 400 grand that you're going to have to deal with at some point.
What I was going to ask you is, since they have that zero basis, the idea is that it's okay to have depreciation for the 400,000 if you buy that asset. You say they just bought the asset, and it would set up to 400,000. The idea is that it's okay to depreciate that 400,000 again because they don't capture it on their end, or
Them, or say that again.
all right. So the seller sells us the building, just the building.
Right.
Which 400,000 is what we paid them. They
Right.
have basis zero because they've taken
Most likely,
1,000 depreciation.
Most likely. We don't know what they paid for it, but they have no
They take
basis
as much
on. Yeah.
depreciation is the idea.
Yeah.
So we're allowed to basically depreciate the fair market value now.
And whatever you pay for it.
And the idea is it that they would recapture that depreciation? Because it almost seems like, you get to have depreciation twice in the same.
And that's okay as long as it's two different taxpayers.
Yeah, fair enough.
Yeah, so like if they, and I'm just making up numbers, maybe they bought that building for 200 and they took $200,000 depreciation expense to take down their basis to zero. And you paid them 400, they still have a $400,000 gain, period. And now you paid 400 for it, so now you get
Depreciate what we paid.
Yeah.
Okay.
Okay? So clearly, from you all standpoint, it's suggested that you would prefer asset purchase as opposed to a stock purchase. It's clear that you all would prefer a stock sale as opposed to an asset sale. So that's the world that we live in. Yes, ma'am.
So then, would you, as the seller, would you try to say, well, if you're gonna buy the asset, then you have to buy it for 500,000?
Absolutely, yes. Yeah, whatever that math is to get you closer.
Right, it might be higher because the
Yeah,
tax.
well, it has to be higher
Yeah.
because of the double tax.
Right.
Yeah. And honestly, at the end of the day, as sellers, I hate to keep referring to it, but maybe it makes it fun. It ultimately depends on how much, take-home money is at the end of the day. Like if somebody says, I'm gonna sell if somebody comes to me and says, well, I'm gonna sell my business for $70 million after tax. But if I do an asset sale that the buyer's insisting on, I'm only gonna take 55 million after tax home. At some point, as sellers, you've got to decide, is 70 what you want, or is 55 what you want? I think we all like to have 70, but let me tell you something, you can't spend what you don't have. Well, that's not true, you've got a credit card, but you can't spend what you don't have. So somebody comes to you with a deal, you ultimately got to say, well, is this going to be, am I happy or content with this? I've worked all my life to build this business up, and somebody's willing to pay me 70 million after tax for the assets, or it's 55 million after tax for the stock. Personally, taking 55 or okay. Maybe I'll try to banter a little bit to get to 70, but I'll just give me the 55 and I'm on my way. Okay. So ultimately you'll have to make that decision. My understanding of the time frame is maybe now is a good time for maybe a 5-10 minute break, 10-minute break, maybe come back 10 to 8, and I'm still going to try to hold on my commitment. 9 o'clock, we're out. Okay. So I'll see you in 10 minutes. Maybe 3 or 4 here missing the sellers. They took all their money and they're downstairs buying drinks and food. That's what it is. All the sellers are gone, all the buyers are here. That's what happens. You sell a business and you go on vacation, you take off. Usually somebody will ask me if they can tape this, which you can. Do people tape anymore? No. They don't say anything bad.
I'm actually taping for a woman who's pregnant. She just had her baby.
Okay.
She's in
For
this
this
class.
class?
Yeah. Dr. Larson gave
How you
permission.
doing?
It's on.
Okay, good. Congratulations.
It won't go anywhere.
Does she want to be a seller or a buyer?
Should be on the seller side.
All right, well, we'll go ahead and get started. I enjoy the interactiveness of the presentation and that. And if I don't get through all the slides, I don't care. And I'll tell Dr. Larson where we quit or what we didn't get through so you don't get popped, in the exam or whatever. And since I don't have a board, if you could either mentally or if need be, write it down, type it up, whatever you need to do. Just a very simple balance sheet. Starting with cash, accounts receivable, inventory. Let me start over. Cash, accounts receivable, inventory, equipment, building, land, intangibles, non-goodwill, and goodwill. I'm not going to use any numbers, but I wanted you to at least have that for perspective for our next session of discussions. Cash, accounts receivable, inventory, equipment, building, land, intangibles, non-goodwill, and goodwill. It's a pretty typical balance sheet, if you will. Either type, read, write, or memorize that. Just a simplified balance sheet. For discussion purposes, I want to just kind of introduce a topic here. And we're going to go from the C corporation context to maybe an S corporation context, just to introduce another concept. Everything that I'm going to talk about is applicable to a C corporation, but it really, really is important when the target is an S corp. Okay, and so that's why I'm going to pretend now that the target is an S corp, and the purchaser is looking at doing an asset purchase. We've agreed, we just fought for the last 3 weeks about stock sale, asset sale, that the owners over here have agreed to sell their assets as opposed to stock, because they're an S corp shareholder, and because they're an S corp shareholder, generally speaking, we don't have to double tax, one layer of tax, one layer of tax. And so we're just going to play pretend. For you guys coming in, if you can just either write, you just got a simple balance sheet. We're not going to use numbers or whatever, just write that down and memorize it. Cash, receivables. Yeah, I need it. Cash, receivables. Just write it down and then we're done. Okay? No numbers, just concepts. So you're over here on the seller side, the buyer side. We've agreed there's going to be an asset purchase. Now let's talk about purchase price allocation. We've agreed that we're going to buy their assets. Okay? They've agreed that they're going to sell us their assets. So let's start the dialogue. As a general statement, as buyers, when you look at that balance sheet that I gave you, as a general statement, where would you like to see your purchase price allocated, and why? Why is it easy to appreciate? You do the math, or what do you mean?
5 year to 7 year period.
Short period.
Not like now, it's never.
Yeah, and it's forever, right? Yeah. So you would like to see a lot stuffed into equipment because of the 5-year write-off. There's something maybe even a little bit higher than equipment. Well, cash, you can't stuff cash. Something in between. You got a 50-50 chance. Pardon me? Inventory, yes, sir. You can flip the inventory even quicker than the 5-year on the equipment. But the concepts are all wrong on the concepts, okay? Essentially, the higher up on the balance sheet, if you will, the more happier you're going to be with the purchase price. So, cash is cash, there's really not a whole lot to do there. And I'm ignoring myself on the camera, stop me. But this is on the test. The receivables, somewhat are the receivables, they are what they are. But the equipment, 5-year write-off probably. Building, 39-year write-off, maybe 15 for some parts of it. Land clearly isn't depreciable. Okay. Goodwill, intangibles. How do you write that off for the tax purpose? 15 years under 197. Okay. What about a covenant not to compete? 3-year covenant not to
Still
compete.
get 60, being put out with us.
Good. You guys are bright. You don't need me. But yeah, it's a 3-year covenant, so 15. So I think we're driving the point home from y'all's viewpoint as purchaser. The higher up the balance sheet, the better it is for you, if you will, because of the accelerated write-offs. Okay? Sellers. Let's talk to you guys. What, as far as the allocation of the purchase price, where would be your tendencies as to the allocation of the purchase price? Where would you guys like to see it? You got it? You all set? Anybody else? Everybody got it? Okay. How about the sellers? What do you think? Cash is cash again. What about receivables? A little bit of a trick there, but what about receivables? Would you want a lot allocated to receivables, or not much, or it depends on something else?
Higher basis asset or something like that?
Pardon me?
When you want it to like a higher basis asset,
To some degree, yes.
So you can have less gain.
Yeah, but remember now, we're selling everything,
Oh,
so net, it's gonna be the same number.
okay.
But what about if y'all are cash basis taxpayer? Would you want a lot of the purchase price allocated to your receivables?
No,
Why?
because don't they have like a zero basis or something?
They have a zero basis, what's that mean? And you
Yeah.
may have missed it, you all are an escort.
Oh,
You're sellers and you're an escort. So any kind of gain that's recognized by the company is gonna what? Flow through to your individual return, okay? So, we don't have building gains, I don't know if y'all covered that or whatever, we're, an escort, we've been an escort from day one, we're good. We don't have a 10-year wait period, nothing, okay, we're good. But if you're cash basis and you sell your receivables, it's all income at what rate? Individual rate, and what do we call that? Ordinary, I'm hearing it over here, okay, and that rate, the highest rate percentage right now in America? 39.6 for discussion purposes. We're rounding to 40, just for discussion purposes. Okay, 40%. Okay. So now for accrual basis, then we have basis in receivables, and it is what it is. So if we have $1 million of receivables and we sell them for $1 million, big deal. Okay. Inventory. You guys want a lot of the sales price allocated to inventory or not? And why?
It's ordinary.
Ordinary income, same reasoning. Yeah, 39.6. What about equipment?
Yeah.
Yeah, what? Yeah, you want, let's say it's above and beyond your basis. Let's say your basis in the equipment's $100,000. Do you want to sell it for 100? Do you want to sell it for 50? Or do you want to sell it for 300? Generally speaking, I don't want to get into numbers, I want to get the concepts. Let's say we're going to have a gain on everything we sold. Y'all run the company real well. You can have a gain on everything you sell. Would you like a lot of gain on your equipment or not so much gain on your equipment? Why?
You have to recapture depreciation,
And what code section?
1245.
Perfect. Check. So if y'all didn't catch that, to the extent that you've depreciated the equipment in your basis calculation, you'd have 1245 recapture on the sale of that. And that 1245 recapture is taxed at what rates? Ordinary, which are 39.6, 40% rounding. Okay? What about the building? We want a lot of gain there or not?
Yeah, it's capital gain, right?
Why isn't it the 12
Why
fifty recap?
I was gonna say, why don't you take your last answer and add 5 to it? He just did it for you, okay? Yeah, he just did it for you. All right, so why don't you hit me with that? 1250 recapture, that's right. So to the extent that you've depreciated your building, you're gonna recapture that depreciation at 25%. 25, okay? And then anything above and beyond that is actually gonna be, there's another section I'm looking for. Pardon me?
Section 1231.
1231. Got it. 1231. And 1231 is one of those code sections that are taxpayer friendly. In the sense that if we have a 1231 loss, what is it? Ordinary loss. If we have 1231 gain, what is it? Capital gain. So we net our 1231 gains and losses, and if we have an overall 1231 gain, it's capital gain. But with regard to the building, we will recapture depreciation at 25%. And then any gain above and beyond that will be 1231 gain, which would be capital gain, which is at what rate? Today's rates. 20, yes, sir. 20. Okay? What about land? A lot there or not? Non-depreciable? Somewhat indifferent? What's the gain on the land? Is that ordinary? Is it capital? Is it 1231? What is it? Capital, it's 1231 actually, but ultimately gets to capital, so that's a good thing, right? And that rate is 20, yeah. What's next? Intangibles, non-goodwill. let's say we didn't buy them, we haven't amortized them at all, it's just some intangibles that we have. We want a lot there or not?
Can you buy it with will and stuff?
Oh, yeah. Yeah.
I thought you had to buy the whole business.
Yeah, you might, I mean, it is the whole business. We sold them the whole thing, which included our goodwill. So what do you think? An intangible asset. You want a lot there or not?
As a seller?
Yes, sir. You're a seller. You came in late?
Yeah, what is
I'm not gonna tell them. You came in late? Okay. So you're representing the sellers. They're the buyers over there, that grumpy group over there. Yeah. You're selling. I'm sorry?
Since there's really nowhere else that we want it to go, I guess it would have to.
Well, it's starting to fall out, right? It's starting to fall out, right? You're running out of buckets to put it into. They paid $20 million for your company. What we're doing is we're allocating that $20 million. We have some flexibility to how we allocate that $20 million. So I'm trying to get you all's perspective on how you'd like to see that $20 million. They have told me how they'd like to see that $20 million allocated. And now I'm asking you how y'all would like to see that $20 million. You can get away with it. I'd say, yeah. Well, why would you want to do that?
I mean, because we can say whatever goodwill is, I mean, right?
Well, I mean,
I would want to, I guess. And it could be.
low rate. Whoever said the lower rate. Yeah. So it's the low rate. The point being is that your intangibles that you didn't buy or that you're not amortizing, those are like capital gain type properties. And so you would get 20% gains, if you 20% tax on those gains, and so that would be a good rate for you. One other quick sidebar is a covenant not to compete. Do you really want to sell that or have much allocated to that or not, and why or why not? A covenant not to compete. They told me that whether it was a 3-year covenant or a 5-year covenant, when they buy it, they're going to amortize it over 15 years, and they were exactly right. Okay? So with regards to you guys, as far as selling, do you want a lot of money allocated to the covenant, or do you want a little bit of money allocated to the covenant? Understanding that the reason why I gave you this paper and listed those out, at the end of the day, it's $20 million, and it's just what bucket is that purchase price being allocated to. And so that bucket of a covenant not to compete, do you want a lot there or not? Got a 50-50 chance. Take a shot. Somebody. Yeah. It's actually, I'll help you. The covenant not to compete is ordinary income. So, if it's ordinary income, you want a lot allocated to it or a little? A little. So, got it. Okay? All right. Now, if you haven't already figured it out, do you see what's happening on that balance sheet between the two groups? Again, I've got a problem. We started off with a problem first of the class. We fought and bickered and whatever, stock versus asset. You're still not sure which way you're going. You know, we fought and bickered, stock versus asset. You got to pay me more, I'll take less, blah, 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 blah. We finally decided that we're going to do an asset sale. All right, fine. I said that we're an S corporation, fine. So now we're allocating this purchase price. And as the gentleman up there has perfectly said, when I listen to you guys, I'm hearing you say, load it up, load up that top, you know, the inventory, the equipment, the building, and no, you know, not too much to land, not too much to the intangible, you know, because you want a quick write-off. I'm hearing you all loud and clear, the seller saying, no, you know, minimize that top, those first 4 or 5 assets, because it's generally speaking ordinary income, and load up the bottom. So, can we do that? I mean, why not? I mean, you bought the company, you just allocate it how you want. You guys sold the company, y'all allocate it how you want.
I'm sure there's some regulations that still
Well, you know, you're right. Because there was a time that there wasn't regulations or a code section. And guess what? Guess what they did? When they spent,
Yeah.
when they spent $20 million for the business and they did their returns, guess where that $20 million was sitting? I'm making this up, up in inventory, right? Okay. Fine, you guys were happy, right? What'd you guys do with it when you got that $20 million? It was all sitting in goodwill. Paid 20 cents on the dollar. Y'all happy and are taking a poke, right? All good. And what's wrong with that? Only in America. You're happy. Let's move on. Yeah, somebody got stuck. Yeah.
So theoretically, could you say that like you're buying land from them, so we would rather have it land, you could say like, well, we need to sell the land, so that's why we want to put it in inventory, but that's why it's land to them, or is it
No, yeah, in my example, the land is just part of the building, like a manufacturing plant, so like the land wasn't inventory that we were holding for sale.
Well, so can the purchaser claim that, and say that that's, we intend to hold that to sell, so that's inventory for us?
No, because ultimately what we're gonna find is because you all did what you wanted, and you all did what you wanted, you're happy and they're happy, there's one person that's not happy. The IRS, right? They got the short end of both sticks, if you will, which again, I'm okay with that, you know, but they weren't, and they're not. So we had both sides kind of dancing to their own drummer, okay? So as a part of that, in 1997 is when Code Section 1060, and actually 197 also, when we talk about the intangible, was put into play that helps us allocate purchase price on asset acquisitions. Okay, what I mean by allocating the purchase price, maybe we'll just start hitting some of these slides, because I think you've got the idea in the presentation. You guys are looking to get up high on the balance sheet. You guys are looking to get low on the balance sheet, okay? And everybody's happy except for the IRS. So let's just kind of flip through some of these slides and see if we hit these key points. Typically negotiating purchase price, purchase price should be allocated, The allocation is used to determine. So whatever you all determine to sell it for, that's how you're going to allocate the gain or loss and report the gain or loss, and however you all decide to allocate it, that's how you're going to go in the books and depreciate and amortize it. So that is important. The parties had historically had adverse interest. Buyers were wishing to, do the top part, if you will. Sellers were always looking to go down to the bottom part. That's what we just talked about. In the absence of an agreed upon allocation, the self-interest of both parties, they do whatever they want. The IRS is the one getting messed up, okay? And actually, prior to 1993, sellers, if you guys sold like a customer list, that would be capital gain, okay? And goodwill is a capital gain. The service didn't like that. And there was too much headbutting because of the purchasers. If y'all bought a customer list, you could amortize it, but if you bought goodwill, you couldn't amortize it. So you guys were always in court fighting the IRS as to, hey, I paid $20 million for their business, $3 million was a customer list, $4 million was goodwill. The IRS, because you could, at that time, you could amortize customer lists, but you couldn't amortize goodwill. And so you guys were always in court fighting the IRS. Well, Congress said, well, hey, let's cut out the fighting. And that's when we came in with 197, Code Section 197, and basically said, I don't care what the intangible asset is. I don't care if it's a customer list, on an asset purchase, a trademark, goodwill, covenant not to compete. I don't care what it is, but whatever it is, it's a 15-year write-off, period. So they started to allow the write-off and amortization of goodwill. That's what happened in 93. This was the bifurcation I just mentioned, which created these two code sections. 1060, which we're going to see, basically is going to make both you guys agree to the application. And 197 that basically says, a purchased intangible is a 15-year write-off. So you're allowed to write off goodwill, you're allowed to write off customer list, etc., and non-compete agreements, but you just can't do non-compete agreements over 3 years. You have to do them over 15, even though the non-compete agreement's only for 3. So let me see what we have here. So what does it apply to? What's code section 1060 apply to? It applies to any applicable asset acquisition, any transfer, direct or indirect, of assets that constitute a trade or business. So in this whole pretend world that we've been doing tonight with regards to you all purchasing their business, clearly 1060 would apply to the transaction. So we're buying their assets and we have to determine the allocation of the purchase price. And so 1060 applies. When it applies, it has the following results. 1, the buyer and the seller and buyer, must allocate the consideration amongst the assets using the residual method. What do we mean by the residual method?
Whatever's left, there's a good one.
Pretty much, yes, exactly. I'm not a GAAP person. This gentleman over here is going to go, he's going to go on the GAAP trail, and so you might be more familiar with the purchase price allocation on a business combination or whatever. But essentially, if we pay $20 million for their business, what GAAP would do is they would start at the top of the balance sheet and say, okay, I've got $20 million. I'm going to start with cash, work my way down, and I'm going to allocate that $20 million to the fair market value of each one of those line items. And then there's going to be a dangling debit, and that's going to hit goodwill. Okay, so you're exactly right. That's what's meant by the residual method. Taking the total purchase price, start with cash, start allocating it, fair market value, dollar for dollar, and then whatever's left, goodwill. Okay, that's what's meant by the residual method. The resulting allocation is controlling. So whatever y'all agree to and decide to do is controlling for both sides of the fence. So y'all are going to have to depreciate and amortize it in accordance with whatever you agree to. You all are going to have to report it as a sale, however you agree to it. Yes, sir?
Can't the IRS do whatever they want though?
Generally speaking, no, and I'm going to have a slide here in a minute. I'm going to have a slide here in a minute that generally speaking is going to say no on that. Okay?
We have to agree to how we appreciate it. Once we buy the asset, we appreciate it. Once we agree to the value, can't we appreciate it however we want?
Yeah, you can depreciate it however you want. That's
Once
right.
the value is,
But the value, so again, you can't say the equipment's worth $1 million. They say it's worth 10 grand. That's not going to happen under this code section now because I got to put both you guys on the same plane. And the service, generally speaking, we've got a couple slides coming up, but I'll just go ahead and say it now. Generally speaking, they're going to respect what you guys said. Why? You agreed on it, but why?
They're gonna get taxed from somebody.
I'm sorry?
They're gonna get the tax from somebody.
They're going to get it attached from somebody?
A tax from
A tax. Or to say it differently, you guys are in direct conflict with each other. But we've just proven that. We've proven the fact that you all want it up top. We've proven the fact that they want it down. And so therefore, generally speaking, the service is saying, well, if you two contractually agree to this allocation, we're going to respect it. Because you all negotiated for that. Because the further down the balance sheet it went, you guys got hurt, they got benefited. The further up the balance sheet it went, it benefited you and it hurt them. So the service is somewhat indifferent because you guys, have negotiated that. Arm's length negotiation. Contrast that to the way it was before those code sections came in, which is exactly what you just said. We paid $20 million worth of stick. We stuck it in inventory and mowed it off the next year. The first round that we sold all of that inventory, guess where they stuck it? They stuck it in goodwill. So who, we're going to use some like that word, who got the short end of the stick? The service. But now, they've got a level playing field, so they're gonna make you two agree to that allocation, okay? Because they know you're conflicting parties and have conflicting interests. Yes,
So is the residual method for 1016 election or?
well, it's actually, you're gonna contractually agree with them to that allocation, and the service is gonna respect it unless it's just completely whacked. So maybe I'll hit the slide. So it's not elective. You guys, when we take that 30 or 100-page legal agreement to buy those assets, within that legal agreement, there's gonna be an exhibit usually that says, we agree that the allocation of the purchase price of the assets is as follows, bang, 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 bang. And you both are gonna agree to that in your asset purchase agreement.
So you don't necessarily have to use residual, you can kind of just come to an agreement with them, is that how you guys want to do it?
That is correct.
Gotcha.
As long as it makes sense.
Yeah, that makes sense.
Right, and again, the service is gonna respect it because they know you have contrary views or contrary desires. So it's truly maybe not a good analogy, and I'm not a finance person, but the efficient market theory, stocks and that, it's kind of like you got two unrelated parties willing to do a deal. I mean, y'all are gonna sit down and reasonably conclude that that is really worth that, that's worth that, and so on. So that's going to happen. The IRS is going to authorize us to use it on both sides, and then it's going to actually require us to file a form with our tax returns. Y'all are going to have a form with your return. Y'all are going to have a form with your return, and it's a form 8594. I think we have a picture of it. And again, the second bullet point up there just drives home what I've already said. If you all agree to that in writing, you're bound to, you have to, do that. You've agreed to it. That's what you've said. And the service is also going to respect it unless they determine it to be inappropriate. It's rare because, again, of the difference between the two parties. Now, I don't know if you figured it out or not, but there is one asset that, quite frankly, you guys don't care, and you can still pull one on the service. What was that? Can you think of it?
Cash.
No, because cash is cash. And when we went through those, it wasn't on the list of assets that I gave you, but it was one that I talked about.
Covenant not to compete.
The covenant not to compete. What did I say on that?
Ordinary.
Ordinary to you guys, yes. And if we didn't allocate, I'm making this up. Let's say we got $1 million left to allocate, and we're either going to allocate it to covenant not to compete and goodwill. Those are the two buckets left. What did you guys want? Goodwill, okay, versus covenant not to compete, nothing. What they want? Or goodwill. Say that.
They can advertise goodwill now as well, so we probably will put it up goodwill.
They don't care. With regards to a covenant not to compete. So in other words, if I take that same fact pattern, we got $1 million left to allocate. We've been negotiating with them for this deal for the last 3 weeks, and we have $1 million left, and we have two assets left: a covenant not to compete and goodwill. How do you guys want to allocate that $1 million? Yeah, you don't care. It's 15 years either way. How do you guys want to allocate that $1 million?
Goodwill.
Goodwill. So that is the one small piece that's still kind of laying out there, where the service, where you guys really aren't butting heads, that you two together can kind of pull one on them. Okay? But otherwise, the rest of it, you win, you lose, or you win and they lose. But the covenant not to compete, if done properly, you both win and the government loses. Okay? So that's the one that there's really, you guys don't care. And they do. And so in order to help get the deal done, we'll say, okay, we'll go ahead and do that deal with you, and we'll go ahead and agree that the covenant not to compete is $100,000 and goodwill's $900,000. You know, we'll go ahead and accommodate you on that, but it's gonna cost you another $50,000 for total purchase price. Cut that out, you know, so I mean, that's just part of the negotiation, okay? All right, I think I've driven this home, but let's just see if there's anything on here that I haven't missed. The IRS and the courts tend to accept the agreed upon allocations. You report it and you adhere to it. And if an allocation that partially mandated residual method, so I think it's answering your question, the residual method is mandated, you know, but you ultimately you're going to get to the same spot. Fair market value and work your way down the balance sheet. And the residual method, we kind of talked about this, but let's look at this a little bit more on the forms. There's different classes of assets, class 1 through class 7. And generally speaking, again, you're working your way down the balance sheet. The next slide shows it a little bit better about the different classes of assets that we're allocating. And we're just starting again at class 1's. Dollar for dollar. Class 2, dollar for dollar, fair market value, bring it all the way down. And then lastly, your dangling debit, your excess purchase price, if you will, gets allocated to goodwill. The actual filing requirement, the form, we've made note of it. And that's what it looks like. Just want to stop here for just a second. I don't have a clicker and one of those red buttons. So, where's that? Yeah, up there, all right there, you see that? Where it says seller or buyer, you check the box, okay? And so for the purchaser, you guys are going to check that box, and we got our name and our EIN number up in the top right, okay? And then it's going to ask for the other party's information. You see where it has name of other party, address, and it has their EIN. Now, and I don't know how early they do it these days, but computer classes, writing a little what if program, pretty easy. That the service can take this form, match up the ID numbers, write a what if program or whatever, and compare those amounts. And if they don't match, they can kick out a notice pretty quickly. So you're telling them, the buyers are going to fill this out. And you might say something like, okay, we put, $2 million here, $100,000 there, $3 million there, 5, 6, 8, and it adds up to 20. That's what you all did. And you've identified the seller, put their EIN number. All right. And then you guys are doing the same form, just the opposite. You guys are going to check the first box up there called the seller. You got your ID number, the buyer's ID number. So when that hits up to the IRS Service Center, they can match those up and make sure that, hey, you said class 3 assets were $2 million. Their form is saying it was $100,000. What happened? Well, what we're going to do is we're going to go pull the asset purchase agreement, and you guys agreed probably in your agreement to a number, and somebody had the wrong number. And get audited and fix it and what have you, okay? I think we've hit this also, but just to make sure there's nothing on the slide that we haven't touched, is that the purchaser, when we buy intangibles, essentially, no matter what it is, information basis, customer list, subscription list, patient files, licenses, franchises, trademarks, goodwill, covenants not to compete. It's 15 years, regardless of what the useful life is. Again, I think we've driven that home with the covenant not to compete. They might have a 3-year or a 5-year useful life, and the covenant runs out after 5 years, but you're still having to amortize it over 15. And I think you all said that Dr. Larson talked about covenants earlier in the session. Why do you have covenants not to compete? What's the whole thought process behind it? Yes, sir.
So like if you own a restaurant that's like Bravo's and you not Bravo's franchise,
yeah,
like John's, and you have your own image and you sell it to somebody else, and then you go the next day, open up a restaurant across the street, you didn't really sell the business. You
Sure.
didn't know it was you own the other one.
Yeah, I mean, you know, when you buy a business, again, it mixes in maybe some finance concepts. I've been throwing around that their business was worth $20 million. How did you all determine their business was worth $20 million?
Actuaries. That's what-
Actuaries, maybe not. Investment banker, but what, if you think about your finance, what do you think about your cash flows, huh? For sure, yeah. And so we're going to do like a DCF model. We're going to project out what our future cash flows are and what we think those cash flows are, and we're going to capitalize it using what we believe is an appropriate rate of return, and then that determines their value. So the value of any business ultimately is its cash flow that it's generating. I mean, ignoring the fact that maybe there's a piece of land on the books that's worth $5 million or something. I'm saying as a general statement, an operating business's worth, the present value is cash flow. So, to the point of a non-compete, if we buy the assets of this business, we pay them $20 million under the thought that, you know, for the next 5 years, we expect our business to throw off $4 million of cash flow to us. So we were willing to pay $20 million for it. To that gentleman's point, if we buy the assets and we don't enter into a non-compete with the seller can just walk down the street, open up that same restaurant, or open up that same business, or open up that same whatever, and all of a sudden, we just bought an empty bag. You know, because they're just opened up the business that we just bought, now they're competing against us, and the $20 million that we paid them, we're out. So I mean, that's why you would enter into a non-compete, is to protect your investment. Okay, so we've got this one. Okay, I'm going to introduce 338, and it's a little bit complicated, and I think we're actually doing great on time. So I'm going to introduce it, and hopefully we can get through it. And if not, again, we'll just unhitch here at 9 o'clock. Any questions so far? I mean, I think, again, I say with all candid, I try to tease a little bit, that you really do seem to be on top of it, truly, from some of the other classes that I've had. Any questions? Any comments? Stock versus asset sale. Allocation of the purchase price. S Corp, C Corp. Questions, comments? Yes.
That's more, I guess, like a future exam question you might have. It says like most acquired intangible assets. Is it obvious the omitted one?
No, I mean, I'd say most. You know, I can't think of a one that's not included. Yeah.
Okay, so you throw
Yeah.
this asset.
Now, were you all tested on this last week or not? No? What were you tested on last week? What I'm going to teach next week? A little bit, yeah, that's what I was okay. Oh, 351, okay, yeah. And 357?
Yeah.
A, B, and C? Y'all remember that? 357A was liabilities? Aren't good. I like that. You got an A, maybe, huh? 357B was bad liabilities. That's why there's a B there. And those liabilities were all boot, yeah, because they were deemed to be attack avoidance. And then 357C was what? I'm impressed.
We spent a lot of that time studying.
Did you? Okay, yeah, I'm impressed. That's good. Good stuff. Okay. All right, so let's go ahead and transition then into the fake world. The fake world of stock purchases treated as asset purchases. So let's set up, and again, I wish I had something to draw, so I just try to do it with my hands. We got the buyers over here still, as we've always had. And we've got the sellers over here, as we always have. And you guys are going to purchase the stock of the seller, okay, for legal purposes. And why might we do that? One non-tax factor that immediately comes to mind.
Liability?
No.
Non-transferable.
Transferability, that's.
Right there. The non-transferability asset, you had an asset, they got an asset that we want, but it's non-transferable. How are we gonna get it? By the stock. What did I tell you all was going to happen if y'all bought the stock of that company? The asset wasn't gonna get written up, right? Okay? And now as we transition to 338, a little bit tricky, but just frame it. You guys, for legal purposes, are going to purchase their stock so we can get our hands on that non-transferable asset. But for tax purposes, you all are going to pretend that you bought that asset and that what you're going to have to pay to do that is you all are going to have to pay the tax on that built-in gain. Okay, so I may have lost you a little bit. Let's use a simple example.
Oh, that's where that aggravated selling price stuff comes?
Yeah, ATSB.
Yeah.
Yeah. Mm-hmm. Which we're not going to talk about, so I don't know if he's going to test it, but I'm not talking about it. I feel that we've accomplished something that at least you grasp the concept. You know, I'm not big on numbers. I'm big on concept. Their land is worth it's worth $1.1 million. Tax basis of 100. Just keep our math simple. Okay. And we've already done all the negotiations, and they're going to sell us the stock. Okay. Because it's non-transferable. Land is non-transferable. I'm just making this up to drive the point home. But the 338 election is going to be treated as if you guys bought the assets. But what you have to do is, you guys have to pay the price for treating it as if you bought the asset. How do you do that? You guys will file a 1-day return for the purchase of that asset, and you guys are actually going to pay the tax on that. So that $1 million difference, the $1.1 million versus the 100 grand, that $1 million difference, you all are going to file a tax return and show that built-in gain, if you will, of $1 million, and pay $350,000 to the government in order to get the right, if you will, to write up that, my example of land might be that example of, say, business, to write up that business to $1 million. So it really costs you what? $1,350,000? Or actually $1 million plus 350, so we bought it for $1 million. We had to pay the government $350,000 for that gain inside it. So it actually cost us $1,450,000. Sound like a good deal? Not really. I mean, we have to actually come out of pocket extra tax dollars just to buy the right to write that up and then begin to depreciate it in the future. Okay? So rarely do you see what I call a 338G election. And what I mean by a 338G election, part of the reason why I'm hanging out on this side of the room, is that everything that I said was done by them. Their choice, their desire, their fake, treating a stock purchase as an asset purchase. That's what they decided to do. Them. You guys, from your perspective, you simply got a stock sale. Period. $1.1 million sales price, and then whatever your outside basis was in the stock. In my example, I didn't have any. I mean, I didn't give you a number. But you guys over here have a straight stock sale. Capital gain treatment, no double tax that we ran through in those earlier scenarios where we had the asset sale and then liquidated. You guys don't have that because it was a stock sale treated as an asset purchase. But you guys had nothing to do with that second statement. You guys have a straight stock sale. You guys are the ones that made that decision to treat the stock purchase as an asset purchase. And you know what? You paid for it. You paid for that right to do that, to write that up. Rarely do you see that done in practice. Now, where you see it done is when we add another fact to the case scenario. Let's assume that they have $1 million, let's say $2 million NOL, net operating loss. And forget Section 382 for a moment. Those of you that are familiar with it, 382 basically potentially limits the use of an NOL when there's been a change in ownership. Okay? So let's forget that for a moment. So their company has a $2 million net operating loss. Now it kind of starts making sense to maybe do that. The 338G, what I call the 338G election, because here's what happens. You all will buy their stock for that $1.1 million, and you're going to treat it as an asset purchase because you want to write that up. But in order for you to write that up, you're doing that one-day return to show that $1 million gain on that land, building, operating business, whatever. Okay? So you do that one-day return, there's that $1 million gain, but guess what? I got a $2 million net operating loss available that offsets that gain. So where you're not paying any tax to the government, and yet you're able to go ahead and write that up, that asset up. It didn't cost you any extra dollars. You guys got that? Again, nothing from the seller's perspective. You all still have a stock sale. And you got $1.1 million, you compare it to your stock basis, you got a gain or loss, capital gain, it is what it is. These are all decisions that are made by that group over there, the buyers. They made that decision, and I would suggest in the second scenario, the decision made sense. Because they ultimately got to write up that asset without having to actually pay additionally to do it. But in the first scenario, they actually had to pay more money just to write up the asset to be able to depreciate it. And again, I know I have land out there, land, building, whatever. You guys get the idea. Yes, sir. Question or? Okay. So I answered it then. Good. So let's hit the slides, the next few slides, make sure we cover them. But that's the idea behind the 338 election and 338G. So the target shareholders recognize gain or loss in the sale or stock. We've covered that. Purchaser would take a cost basis in the stock. This is without 338G, right? And the corporate tax attributes would just generally be unaffected. You all had just bought their problem. Remember how we talked about that earlier? You all just bought their built-in gain problem. Okay? So that's what a stock purchase looks like without 338. With a 338 election, you guys have one of four things that you could do. Number one, buy their stock, not make the 338 election, keep their company alive, and what do we have? We just have a parent-sub relationship. Remember we were saying that earlier? That's option one. But the assets didn't get stepped up. Okay? Option number two is you buy their company stock, you don't make the 338 election, and you liquidate on the 332. I don't know if y'all covered that yet, but what happens when you liquidate on the 332? Actually, no. It's just a carryover. Because that's on 8%.
I'm sorry.
Yeah, subsidiaries liquidate. Yeah. So that would just go up tax-free carryover basis. Okay, so you still don't get your write-up. Okay. The third alternative is that we buy their stock, we make the 338 election, and we do this fake transaction. Okay? We do that fake transaction, and I now have a parent sub that now the inside basis of the sub, in my example now is $1,450,000, $1,000,001 paid plus the $350,000 tax that we paid. So the inside basis now is $1,450,000 sub. Or I can make this election. This is now $1,450,000 and liquidate that sub up, and it's still $1,450,000 up here. Okay?
But the tax you pay is part of the basis, you have that.
Yes. Yes. Cool in the sense that at least you've got a basis for your money, but all you're doing is just paying. Here I go again. I was only going to use a one. So you just spent that to be able to depreciate that over, pick a number, 15 years, 20 years. So yeah, you're not totally out of pocket, but why pay that now to write it off over 5, 10, 15, 20 years, depending on what the asset was that we bought? Pretty soon I'm just going to be reaching in for change. Okay? All right. So, I think the second bullet point, if you just look at this, and again, you guys have this in your slides, that I'm not going to go through the history of the general utilities document because I'm starting to run out of time. But this 338 election that y'all make does come at a cost. And I think I pointed that out because you all are paying the tax in that building. And that's what this is essentially saying. Now, what qualifies under 338? You all have to buy at least 8% of their company stock. I've used 100 just to keep the math simple. But if you buy 80% or more, then you can make that election if you so choose. It provides the buyer, let's see, ensures the targets bear the same tax burden, provides the buyer with a cost basis. We've covered that. It terminates the tax attributes. Lives, methods, because it's a whole new asset purchase, if you will. This is getting into more technical qualified stock purchase. You don't have to do it all at once. You could do it 40% today and 60% a month from now. That 80 within a year. I woke some folks up. As long as you do that within 12 months. Yes, sir.
So it terminates the tax attributes, you can still use that NOL?
In the NOL on that deemed sale, yes.
Okay.
And then that last bullet point is what we were just saying, that T must recognize that hypothetical asset sale afterwards it returns as a virgin corporation with a cost basis and assets and none of its former tax attributes. You can't use the NOL that was available. So this is the 338G. It's an election made by them, and I keep emphasizing that because I'm going to switch gears on you in a bit and go to an H10. This is all on them. Their choice, their decision. They filed this form 8023 by the 15th day of the 9th month. And this one return here, this one-day return is where the old target is deemed to sell their assets and they can pay that tax. Target must recognize the gain on a hypothetical sale. We've talked about the target's NOL available to offset that. New target's assets then are the required tax basis. The key here, and I'm emphasizing it, the economic burden of any tax falls on you guys. So it's your choice, your call, your payment. So we'll flip it in a little bit. So the economic burden falls on you guys because you guys own that subsidiary that filed that one-day return to reflect this election and pay that tax. Seller's perspective, we've spoken about this. From the seller's perspective, got a stock sale. All of this stuff I'm talking about is done. You guys got a straight stock sale. Purely fictional, the asset purchase. Again, from a legal standpoint, it's a stock sale. Stock sale, straight stock sale. This is all pure fiction for tax purposes. Let's talk about 338H10. I'm sorry, I don't have something to draw on. Take my word at it. But if I have a parent and subsidiary, and these guys are the sellers, got to switch left in. I got a parent and subsidiary, you guys are buyers. And you guys buy the stock of the subsidiary from the parent. There could potentially be 3 levels of tax. It's easier for me to draw it up and watch it. So you guys are buying the stock of that subsidiary. So that parent has a gain on the sale of the stock. Okay? The parent then, here's my chart. I'm going to get my own chart. And if you guys made a 338 election for the purchase of that subsidiary, you guys would pay the tax on that write-up. The parent over here is going to pay tax on the gain on the sale of the subsidiary, that stock sale. Okay? And if the parent decides to distribute the money out to its owners, those owners pay income tax. So you potentially have 3 taxes if you guys buy their subsidiary and make a 338G election. 3 taxes. So you guys buy the sub, make the 338G election, that's 1 tax. This parent over here sold the subsidiary, that's a taxable gain. That parent took its proceeds, distributed out to its shareholders, that's a gain. 3 taxes. Okay? So to help minimize that, this code section, 338H10, exists, and it's used in 2 ways. When the target is consolidated group, or the target's an S corp, we're going to address that later. When the target is consolidated group and they're selling a subsidiary. And again, this is the potential 3 levels of tax. When you guys purchase T stock, the target, the sub, make it 338. It's first tax. S has a potential taxable gain to seller, which is the parent, and then S distributes the proceeds to the shareholders. That's the 3 level of tax. So 338H10 offers some relief from the triple level by doing this, that it's going to treat the purchase of their subsidiary stock as an asset purchase. So that basically the subsidiary, the target, went into the parent and they were just going to sell the assets then to you guys. Okay? So that there will only be 2 levels of tax. Their gain on the sale of the assets, and if they take that money and give it to their shareholders, that's 2 levels. Okay? Here is the main thing that I want to drive home on this topic. This is the mechanics of getting there. Right here. If y'all can do that, highlight that or whatever y'all do in your stuff. Here's how this one differs from the first one. The 338H10 is a joint election. So you both are agreeing that this stock sale is going to be treated as an asset sale. You both have to agree to it. If you both don't agree to it, it's not happening. You both agree to it. Okay? The in the 338G, remember you all made the decision and you all paid the tax. But with a 338H10, you guys are going to jointly elect it. But the burden is going to be on you, the sellers. Okay? And you guys are going to be okay with doing that to the extent that you guys have NOLs available or whatever to help offset that. Okay? And you would be okay with doing that. So at a very top level, again, it gets a little bit tricky, and I know there's chapters in your books on it. But when I think of 338, I think of it in two concepts that are very important. Number one, in the 338G election, or the 338 regular election, if you will, it's a unilateral decision by the buyer, and the buyer pays the tab. And rightfully so. If it's their unilateral decision, they pay for it. And you guys just have a stock sale. But with a 338H10, it's a joint election. You both have to agree to it. And because you both agree to it, it's on your tab. And you know what? If you don't want it on your tab, then don't agree to do it. Okay? But that's the key that I want you to walk away with. That under both elections, at the end of the day, it was a stock purchase treated as an asset purchase, and so therefore the assets do get stepped up. It's just a matter of, is it a unilateral election and they pay for it, or is it a joint election and it's on your tab, i.e. you report the sales of the assets. And this does apply to S-Corps also. And with regards to S-Corps, if you guys are an S-Corp, very common, because the S-Corp might have non-transferable assets, and you might want to do an asset sale. You guys want to do an asset purchase, right? We've been saying all day how you guys want to do an asset purchase. Well, it's easy to do a 338H10 with an S-Corp because you're running one level of tax. And so what you guys are going to say to them is, hey, we'll do a stock sale, do a 338H10 election, and let you write up the assets, you know, so you can depreciate them going forward. But you need to work with me on asset purchase price allocation. Okay, so we get back into that discussion that we had before. You know, you scratch my back, I'll scratch your back kind of deal.
Everyone else will inherit your liabilities, so.
Yeah, no, yeah, that's right. You're pushing it back on. That's fine. Yeah, exactly. I mean, that's just part of your negotiations. Absolutely. But a 338H10 election is available for an S corporation target. Questions, comments? I finished an hour and 10 minutes early. So I thought we were here to like 10 or so. Questions, comments? Otherwise, you're dismissed, and I'll see you next week. Yeah, my pleasure. Pardon me?